G'day everyone, and welcome back to the Sachin and Adam show. This is actually episode 50, so Adam and I will have a 12 a.m. beer after this to celebrate. But as you can see, we're actually in a different location, and we're here at Beckon Capital offices. We've become a bit of a mobile unit recently with coronavirus, but we are really excited to have Phill and Moffitt on today.
Yeah, cool. So me and Sachin have met Phill a couple of times. I actually met him through sort of my high school alumni group. But Phil's had a very impressive career spanning the investment banking world, working at the RBA, did some sort of late university practice, and then started his own impact investment company. But basically, he was a partner at Goldman Sachs for over 20 years, went back to uni, did psychology, and now started Beckon Capital, which is a really cool firm which is trying to mix a lot of finance and social impact. So thanks for having us.
Oh, it's a pleasure. It's nice to see you guys.
Yeah.
And I think when me and Adam first saw Beckon, we were like, oh my God, because this is very similar to what we want to do with our lives. And we've been seeing it time and time again, this intersection between business and impact and how it's going to create the future. So we're excited to dive into that. But before we go there, we want to get to know you a bit better first. Is there any story or kind of anecdote that you can share with us that kind of tells our audience who you are as a person?
There's probably lots. There's a pretty consistent theme, I think. So I'll give you an example of one that really sticks in my mind, which was I'd started work, so I was a bit older than you guys, but not much. And so, I'd done all the normal kind of teenage things and played sport and was reasonably fit and able. And I'd been at work for about 18 months, and there was a corporate triathlon. Came up, put my hand up, everyone was doing it. It was a little mini triathlon, 500 metres and 5 kilometres kind of thing. Oh, that's going to be easy because, do that in my sleep. And you know what? It wasn't easy at all. In fact, I kind of conked out in a swim before I even got to run and bike. And the learning from that, the message from that was that just because you could do something doesn't mean you can do something. And so as you accumulate skills, what I've learned is as I accumulate skills or experiences or capacities, if I don't keep working at them and maintaining them, they actually waste away, just like your muscles waste away. And I'm also discovering as you get older, they waste faster. So don't assume you can do tomorrow what you did yesterday unless you keep working at it.
Does that keep you hungry and motivated?
Yeah, well, it keeps me hungry and motivated, and it makes me focus on. You've only got so much time, right? So it makes me focus on the skills or the knowledge that I want to maintain, and to focus on that, and to become rational about stuff that you can't maintain, and you've got to make a decision, and you make a conscious decision to let it waste away.
Yeah, I think that's good advice because we're kind of in the age of the generalist where people in our generation have so many different careers and stuff. And there's so much information everywhere, and it's so easy to learn things. So it's like, what skills did you maintain? Obviously, there's those things like health and those things that you really want to maintain. But in terms of your skill set, that's actually a very interesting point that we haven't heard before.
Really important. Now, if we can go back to sort of maybe your childhood and your university days a little bit. So you were a partner at Goldman Sachs for 20 odd years.
Not quite 15. I was there for 20 years.
Yeah.
I was in the partnership for 14, 15.
Yeah. So how did you end up at a place like Goldman Sachs and now you're in impact investing? How did that all happen?
Oh, look, I'm 56. So I finished school in 82 and went to uni. And you guys, lots of the listeners will be scrambling through their ancient history books. But what happened, and I studied economics law. My mother always wanted me to be a solicitor, and I didn't know any different, and so I kind of got in, so I did it. But I always liked economics, and it turned out I was quite good at it. And I never finished my law. I did an honours year, and there was an opportunity to work at the Reserve Bank as a cadet. So the Reserve Bank employed half a dozen cadets from around Australia. So in your 4th year in your honours year, you also worked at the bank. And the career path at that stage for people who studied economics or finance was generally you either went to Treasury or the Reserve Bank. The kind of the most able students, the ones that they were the two target places to go and work. But we had a change in government in Australia in the early 80s, and Hawke and Keating kind of revolutionised the financial markets. So flooded the exchange rate, introduced foreign banking licenses. So there were 16 foreign banks came to Australia. I think it was 16. Basically, the year I was graduating. So there was this massive demand for people with my skill set or my peer group skill set to go into these organisations. So we all just ended up, this generational group ended up in that sector. And I went to work for a firm called Bankers Trust, which doesn't exist anymore, but was a fantastic place and a great training ground. And that was dumb luck that I fell into that.
Yeah.
And I fell into the asset management part of that, which was dumb luck. I was allocated there.
Phill, out of curiosity, did it kind of have the same prestige back then as it does now when it was first being established?
Bankers.
Yeah.
Yeah, well, you know, I'll tell the story from the Bankers Trust perspective, but there were basically two premium places you wanted to work.
Yeah.
One was Bankers Trust and one was Macquarie Bank. And so I interviewed with both, and they're quite different. Macquarie Bank people out there, but Macquarie Bank were basically a bunch of insiders. You know, they came from the right place and the right clubs, and it was, you know, that whole thing. Bankers Trust was deliberately built by a group of outsiders. So the guy who ran it at the time was a guy called Rob Ferguson. He'd come from, you know, East Hills Boys High, and we had all sorts of kind of people from the wrong side of the tracks who were very able and very hungry. And so I interviewed at both, and it was pretty clear to me that there was a big difference. And you might suggest that I should have gone to Macquarie, but I like the culture at BT, and so I went there. And in fact, this business here, Beckon Capital, has been set up by three people who all started as grads at BT, so we're all roughly your age. We started work together in slightly different areas, but we've known each other forever. We've got here half a dozen people who had worked with BT.
Interesting. It sounds like there was a whole generation of people that were influenced by the economic trends of the time. So like,
well, it was the 80s too, right? So it was, you know, padded shoulders and suspenders and all that. You know, that was that period.
Interesting. Because I guess the way we think of career choices, we think people make very conscious choices. We like do a lot of evaluation of what you want to do, then you go and do it. But sometimes it's really counter that. It's just like there's an industry-wide change and people just flow into that industry. Yeah,
absolutely.
And then, so from BT, how did you end up at Goldman Sachs?
So I was at BT for 10 years and did well, was doing well and enjoying it. But I guess there was this kind of nagging doubt around how good I was versus how good the team I was in was. And I had a desire to try and test myself. It was also, frankly, a good time. I was married. My wife was doing well and was happy. We didn't have no kids, or, you know, it was a time you could take a risk. And I was approached by somebody who used to deal with me quite a lot in my job to move to Hong Kong and join a Japanese bank, which was setting up what's called a proprietary trading business. They don't really exist so much now.
Was that Nomura?
No, it was called Tokyo Bank. So Tokyo Bank was the biggest bank in Nagoya.
Okay.
And it had established a proprietary trading business. So proprietary trading is when you're actually trading, buying and selling stuff with the bank's own capital. As opposed to investment management, where you're investing in things with other people's capital. And so I went up there and joined, there were 5 of us. There was another fellow from Bankers Trust in Tokyo was recruited, and then there were 3 Goldman prop traders. And so I moved up to Hong Kong and did that job for 3 years. So in that kind of environment, you eat what you kill, right? So you basically get paid a salary. You've got to earn the salary back, and then once you get through that, there's a percentage.
So what were you trading specifically?
Well, you know, the mandate was to trade basically anything, but for me, it's always been kind of macro markets. So currencies, fixed income, credit. We used to trade equity indices a bit, but that was just a way of giving money back most of the time. I think I found anyway. So my whole career has been as a macro investor, rates and FX.
So did you have a big thought process that you went about into like what you were going to invest and how long you're going to hold them for? Like, how did you make decisions?
Well, so I think for me anyway, investing's about process. And it's about self-discipline and knowing yourself and fitting a process around that. That's been my kind of journey through the life of an investor. So I've been, you know, investing for 30 years, more, 35 years. So for me, I take quite a fundamental approach. I'm an economist by training. I understand economics, I understand national accounts, I understand trends in inflation and growth and so on, and would apply that to come up with a macro view, and then the guts of it is forecast a set of potential outcomes from that macro view in terms of interest rates and exchange rates, and then look at how the price in the market reflected against those, and look for disparities. And then when you find a disparity, you're about 10% of the way down to a trade. Just because you see a disparity doesn't mean you should do anything about it. You're trying to figure out why it's there.
Yeah.
Is it being sustained by some other factor that you've not been considering? And you start to learn about different factors that might be at play and how to incorporate them. And then the most important part of the whole exercise is trying to figure out how much you think you can make, and more importantly, how much you think you might lose if you've got it wrong, and then scaling the risk to suit those parameters, and then sampling frequently. So for me, sampling frequently doesn't mean trading 1,000 times a day. It probably means having half a dozen to 10 different risk positions over kind of somewhere between a month and a 6-month holding period. But doing that consistently, because nobody's 100%, right?
Yeah.
Very few people are 50%, and in fact, you can be a very profitable investor on 40% if you're really good at managing the 60% losses. So what I learned was that being successful in investing money is all about managing the losses.
Yeah.
It's not about focusing on the wins, it's managing the losses, understanding how to manage the losses, understanding when to cut the losses, understanding when to add, and being really self-disciplined.
Do you find that to be a big contrast with the earlier stage investments you're doing now? Because a lot of typical VC funds, they're really about getting outsized returns with a couple investments. Is that completely counter to that?
No. Well, firstly, Beckon Capital is specifically designed to invest in existing businesses. So we call it growth equity. That's an unusual term here. In Australia, people are kind of familiar with the idea of a VC. A VC is generally taking an idea or a really early stage business and taking a bet on the founder's ability to execute. The VC model is, you might invest in 10 and you hope that one hits it out of the park. And then maybe you've got 2 that are okay. PE, private equity, generally is a strategy that's used to invest in mature businesses. So a business has gone through its maturity phase, it's become inefficient, it's become flabby, so it's like boot camp. PE takes it, cleans it up, moves it on. In between those 2 stages are businesses that are going through their growth cycle. They're already operating businesses, they've got cash flow, they've got product, but they want to go to the next stage. So maybe they want a new factory, or they distribute in a new place, or they want to bring a new product line on. And those companies in Australia are really starved of capital. So small, medium businesses traditionally would have gone to the banks for debt finance. Debt is a loan, right? Debt, I think of as like a stick. You don't perform, you don't meet the criteria, we take it away. You've got to pay interest all the time. Equity, if you become a co-investor, a co-owner in the business, it's like a carrot. If we don't help you grow your business, we don't make any return for our investors. Coming back to the idea about cutting your losses and riding your gains, in this business where you don't have the capacity just to go to market and unload risk, the requirement to make really good initial decisions is critical. It's all about making good decisions early on. And the real skill for us is knowing when to say no. And saying no quickly, so that politely, with reasons, but saying no quickly so you don't spend a lot of your analytical energy on stuff that you can't carry through, and you can maximize the amount of time on the stuff that you actually work on.
Interesting.
So in this kind of growth equity stage of the business, your risk management strategies is more saying no early and diversification? Is that what you'd say?
Yes. And so what's interesting about this space, in Australia in particular, in the US is more established marketplace, but in Australia the investors, the equity investors in small, medium businesses tend to be hobbyists, but small entrepreneurial groups. There might be family offices or small groups of investors, but they tend to have a small number of investments, and so they're actually taking quite a lot of stock-specific risk. Our approach is to build a technology platform that helps us say no fast, helps us support multiple investments, and as portfolio managers, we know the best way to manage risk is diversifying. So instead of having a portfolio of 2 or 3 companies, you want to have 40, because it's spread across different businesses, different locations, different specialties, because that way you can minimise the risk of having all your eggs in one basket, essentially.
Cool.
I'd love to dive into the technology and also your patient giving patient capital philosophy a little bit later. But something I think we're both curious about is that you actually studied psychology for a while, and I think Adam and I are on our own journey to be better investors. We obviously have each other to check each other's biases, but there's obviously so many unconscious biases, which as an investor you have to check yourself with. But also in broader in life, I feel like that study may have kind of framed your way of thinking.
Yeah, well, the reason I ended up with psychology is that I slowly discovered, and so when I started my career and I studied economics, there was really no talk about behavioural economics.
Yeah.
Kahneman and Tversky hadn't written yet. And so as I've evolved through my career, I became more and more familiar with the behavioural economics literature, and of course recognised that I was living that world, right? We were fundamental investors in financial markets. Often they were the case studies that were being used by Kahneman, Tversky and Thaler and these guys. And a lot of the issues they identified as inherent biases I could see in myself and also the people who were working for me. So I became more and more interested in what it was about the individuals that led them to have these biases. And I kind of wanted to formalise that through some form of study, and realised that if I wanted to try and focus on the individuals rather than the aggregate market, that I had to actually move away from economics or the business school and go to psychology, because it's really in psychology where individual differences are focused on, rather than aggregates. And so I went back and I did basically my undergrad in psychology part-time while I was working, and then I did an honours year with a whole bunch of people like you, which was really inspiring because...
Did you ever go out for beers with them?
Yeah. So I was the old guy in the corner, and I did well in that. And so my supervisor suggested I keep going. So I'm enrolled in a PhD, although it's on suspension at the moment because of this. And what I'm really interested in is the personal characteristics of people who make very good investment decisions or personal decisions. In particular, the post-decision risk management phase. So I think I said to you, the mark of a great investor is not people who can identify good opportunities. It's actually people who can identify mistakes and manage their mistakes quickly and cleanly. And I'm really interested in what is it about those people that's different. What are their individual characteristics?
Any elementary findings so far?
Look, I think a number of very successful decision makers that I've dealt with, not just financial market decision makers, might be a bit spectrumy. That they see things differently. They assess things differently because the mistakes you make, particularly in financial markets, you make it because everybody else has got the view, right? So you need to be able to look at things differently and then be brave enough to say, I'm different and I've got a different view and I'm going to express that view through some sort of risk position, right? So if you're somebody who likes to be with everybody else and likes to feel good in a group and all that, you're actually not necessarily the kind of personal characteristics you want. You actually want somebody who's always picking away and looking. So I think there's elements of, if any of you listeners know your personality, individual difference, psychology stuff, there's, conscientiousness is an important personal characteristic. Absolutely. But I think the one that I'm honed in on is a facet of personality that's called tolerance for ambiguity. And what that basically means is, are you comfortable living in a space where you don't actually know what the outcome will be? And what drives a lot of decisions is anxiety, in my my view, but my research too. People feel really anxious when they don't have an anchor. And so they will do something to close the door on ambiguity. And if you don't like ambiguity, you'll be inclined to not take a risk position, or if you're in a risky situation, do everything you can to close it down fast, because being uncertain really makes you feel bad and uncomfortable. There are some people who actually can sit with ambiguity very successfully. And I think that's probably the characteristic.
Do you think when they're sitting with this ambiguity, they have conviction that they're right, or is it more so that they're okay with being a bit more risk-seeking?
No, I think it's related to risk appetite, which is a different kind of construct in psychology. But it's the capacity to be confident in your view, but allow yourself to believe that you could and may be wrong at any time, and that you don't know, and as a result you have to keep testing the thesis, and you have to be prepared if the thesis looks like it's not working out, not to be so invested in it that you cling to it, but you just move away. You just kind of unemotionally move away, and that's been my experience.
Interesting. So after doing the psychology degree, you entered a very different stage of your life, I feel, with Beckon Capital. And before we sort of explore that, just in a very reflective viewpoint, I think Goldman Sachs, it sounded very stimulating. You got to really think about economics and individual decision making. Were you also fulfilled over the sort of course of your career in the really holistic sense?
Oh no, Goldman's. Probably most people on the podcast will recognise the name, or you Google it, you'll see a lot. So it's a big, successful US investment bank. And I went there to a job in London. It was great. I was going to go to London and do something big for an investor particularly in global macro assets. So government bonds, corporate bonds, credit, currency trading, all this kind of stuff. London's the capital of the world.
Yeah.
New York, the financial markets in New York are very focused on US assets and US analysis, and London's really the capital. So I kind of progressed to the EPL or whatever. I was playing in the league, and I was playing at a good place, and I had good people around me, and so the capacity to actually test yourself against the best in the best place was really a great motivation.
Yeah.
Also, working with a really globally diverse set of people was great. In Australia, we talk about being diverse, and we are, but the vast majority of people here have come here because they want to be Australian, or they want to live in Australia. I found in London a whole population of people who they had no desire to be English. They were French or German or African or they were American or came from anywhere. And they came to London because it was London to work in London for a period of time. And so there was this kind of real mixture of cultures and diversity and way of thinking, people who'd been trained in universities all over the place. So it was really rich. But it was the 2000s by that stage, or 99 I went to London. So it was the 2000s and in the 2010s. We had a couple of crashes along the way, but it was also boom times in the financial markets. And so it was an exhilarating period and place, but it was a real bubble. It was a real bubble. So if you watch these kind of TV shows, I don't mean Wolf of Wall Street kind of stuff, nothing like that. But the whole kind of Big Bang, 80s, wealth focus, power dressing, Maggie Thatcher, that's whole, London was full of that.
Yeah.
Or the aftermath of that.
Did you enjoy that lifestyle at the time?
No, not really, because at that stage we had two small kids.
Yeah.
And my wife's from Sydney, and our families were here in Sydney, not there. So, I was working Goldman time, so, basically 7 days a week, whenever they wanted you were there, conference calls all night, the whole thing, travelling a lot. And she had our two daughters, and it was just full on. So, there wasn't really much time or opportunity to get swept up in it.
Yeah.
Interesting. So, saying that, did that sort of influence your decision to start Beckon and go on this different journey afterwards?
Yeah, I think when I left Goldman, one thing Goldman does, this is a great thing, I think. Again, if you Google Goldman Sachs, you'll see stories about vampire squids and Malaysian court cases and all this kind of stuff. At its heart, Goldman believes very strongly in community service, philanthropy. And that might sound really odd. But the culture in Goldman was basically up and out. And the idea was that the social contract was, if you're good at your job and you're productive, we'll promote you and we'll pay you. But you're not going to have a 30-year career. The average tenure in the partnership used to be, I don't know if it still is, was about 6 years. So becoming a partner at Goldman, it's like, it's the big prize on Wall Street.
Yeah.
And it's a big process. And when you get there, you realise that the pressure goes up a lot, and if you're not producing, the pressure to leave goes up a lot. And so the social contract is that after you've worked with us for a while and you've done well, and we've ensured you do well, now you go and do something good. And as a result, when you become a partner, Goldman help you set up a foundation. And some of your comp is diversify, is channeled into a foundation, and is basically you're taught how to become philanthropic.
Mm.
And so I really enjoyed that.
Yeah.
I really enjoyed that. So it's a very big US culture, it's kind of
Make money and then get that.
cultural thing, competitive giving, I call it.
Mm.
We don't have it here, right? Not so much. But I really embraced it. So when I finished at Goldman, I just put some more money into the foundation and thought that I'd kind of see out the rest of my days studying and investing the foundation money. And when I thought about what I wanted to invest the foundation money in, I wanted to invest it in stuff that was having a positive impact. I didn't call it impact, but businesses that were doing good as well as making money.
Mm.
And I saw that as kind of a way to double your philanthropy, because not only were you making charitable donations out of the earnings, but you're actually making earnings out of doing good stuff. And that brought me to focus much more on what we call impact investing, and realised that, again, as a portfolio manager at heart, that if I was doing it on my own, I'd be a really fragmented entry into the market. How would I find people to invest in? How many could I invest in? How would I manage it? You'd end up with 2 or 3 risk positions.
Yeah.
So I rediscovered some old colleagues of mine who had similar ideas, and we put Beckon together to be a platform that could gather bigger pools and then invest in more businesses, so diversify the risk and have bigger impact.
Mm. It's such a cool vision. Quickly before we move on to Beckon, in terms of your time at Goldman's, I didn't ask before if you were fulfilled, but I'm also I'm also curious to know, do you have this innate competitive part of yourself that kind of led you to becoming partner? Because it seems like in that culture that you kind of need that.
And, I was pretty, I was really driven when I was young. I was really driven.
Yeah.
And
what drove you?
I don't know, fear of failure.
Mm.
Probably fear of failure. I felt this, you could get my therapist in, I felt this real obligation to perform. My mum and dad, so pay for my education, really great school. But they worked 2 jobs or 3 jobs to do it. And I grew up in I had nothing wrong with growing up in the western suburbs, but I grew up in the western suburbs, I got the train to school, and most of my colleagues didn't grow up that way. And so I could see opportunity that I felt obligated to take advantage of, I think. And I think that's what really drove it. And then when I found that I could do stuff, I started to enjoy it, but I always felt obligated. I still feel obligated. I could be down at the beach, right? Really. And Beckon's great fun, but it's running this is stressful, man.
Yeah.
And I'm doing it because I feel like I have to as much as I want to.
It's really interesting, and I think that that's a trend that I've noticed a lot recently, is that when you put a kid that doesn't necessarily grow up with a silver spoon in their mouth into an environment with opportunity, I've seen time and time again that they end up being very successful.
Yeah, so I'm really driven by that. So one of the other things I do is I'm the chair of the school's foundation, which raises money to create bursaries for people, means tested bursaries.
Yeah. So
that you can have again, portfolio theory, not 1 or 2 token kind of students who come in, but you can actually be supporting. Our objective is to have 20% of each cohort of each year group being supported on bursary.
Wow.
So it's just big ambition. Yeah, so we've got to raise a lot of money.
Yeah, wow. So going back, if you were to do it all again, would you have done the same things with Goldman?
Yeah, probably. If you knew which horse was going to win the race yesterday, you'd put the house on it, right?
Yeah.
So looking back, there were opportunities to leave Goldman and do something for myself. And I think that probably would have been more remunerative. But I was learning a lot of Goldman that I didn't realise I was learning at the time, and I was making this kind of really deep set of global connections and friendships.
That's probably helped a lot with Beckon as well.
Yeah, and so it wasn't until after I left, and it is a bit like there's a grieving process in a sense when something owns you completely for a long time, and I was trying to figure out what that emptiness was about. It wasn't the paycheck. It wasn't the office with your name on the door. It wasn't that at all. It wasn't the business card. It was actually the interaction with the people, the colleagues, the clients, and so on. That suddenly dissipates. And so I wanted to try and find a way to replicate some of that.
Yeah.
And to do that in a place where we can make money for our clients. People aren't going to invest in their strategies if they don't make money, but also have a demonstrable positive impact.
Yeah, awesome. So I feel like we've got a pretty good scope of why you started Beckon now. Do you want to explain a little bit about the philosophy of Beckon Capital in terms of how you're making decisions, but also how you integrate the returns, the finance with the impact,
and I'm
what
also
your vision for the world?
I'm also interested to dive more into this tech platform.
Okay.
I think that's really
we'll speak about that.
So let's start with the mission.
Yeah.
Mission of Beckon. So I work with a couple of founders. Chris Self is really the driving force behind the foundation.
Yeah.
And he would say, or we would say, the mission is to get capital to where it's needed, to where it's deserved, and where it's absent. So you would think that in a sophisticated capital market, with investors at all scales and sizes, that those who want to use capital to generate returns would have various pools of it available to them at various prices. So, you know, there's a risk premium that are all attached to an investment, but even risky investments, in theory, should be able to attract some capital at some price. What we know is that there are actually big parts of the capital structure in Australia that don't have ready access. And so what's happened here is that you've got a consolidation of investable funds in supers, superannuation funds largely, and they're actually merging and they're becoming bigger and bigger and bigger. And so the other thing I do is I'm a director on Aware Super, so that's the super fund that does looks after police and teachers and nurses, ambulances and stuff. Aware would love to be able to invest in high returning assets that actually help the community as well. But it's really difficult for big pools of capital to look at individual small deals because it's just not time efficient and it doesn't make a big difference to the overall return. So as capital becomes more and more concentrated in big pools, it actually becomes less and less available to smaller assets and businesses. Historically, smaller businesses, that in our kind of thinking, that's a business that's got an enterprise value, kind of a total value between maybe $5 and $50 million. So you think $50 million is a big business, it certainly is, but it's still not really big enough to attract institutional funds.
Yeah.
And historically this space has relied on bank lending. And a consequence of increased regulation in the banking system and the royal commissions that we've had and all that kind of stuff is banks actually become much more conservative about their lending. So they're actually withdrawing from the space. And small businesses in Australia are roughly 60% of GDP. So they're almost 2/3 of GDP. They're about 68 or 70% of jobs. And they're 98% of companies.
Wow.
Or 98, I think 97, 98, something like that. So there's this massive space here that drives communities, jobs, income, and the economy. And it's being starved of the capital we're saving. And as a result, operators in the space do what they can with what they've got, but if they think that they can create more value and be innovators and drive growth and change and so on, they can only do it if they have the right structure for a bank to want to fund them, and then the bank will only generally fund them with a personal guarantee. So you've got to put your house at risk to try and improve your business, or you get lucky and you meet somebody who backs you. What we're about is actually making capital available broadly through that sector, which is really very fragmented, by using technology, a technology approach and online communications tools to actually communicate more broadly with the sector, attract the sector, and then start to be able to do analysis through what we call an onboarding platform, but basically an online system or sits in the cloud. The analysis system sits in the cloud, and we can start to do the first stages of analysis, and in a really scalable way.
So how did you go about systemizing this process of analysis? You don't need to give away your IP or anything like that. But
But let me come back to the impact part too before I do that. So the other part of our thesis, it's our hypothesis, is that impact 1.0 basically was there used to be this debate. I hope your generation don't even think about it, that you could only have impact, positive social impact, if you gave up profits.
Yeah.
It was a trade-off. And that's bogus. And what Impact 2.0 discovered and revealed was that you could actually have both. They could coexist. What Impact 3.0, what we're championing, says is actually, if you understand your impact, when I say impact, I mean all your externalities. Right? Every activity has externalities. If you can understand your externalities and manage them and improve them and incorporate them into your business decisions, you can actually drive profitability through your impact. So a really simple example, lots of government tendering programs now require impact companies to be compliant with broadly impact conditions. Who can afford to do the audit and work to measure all those things? Big companies. Not small companies. Small companies gets closer.
Yeah.
If you are building a product that you want to sell consumer sales, and you actually understand your impact, and you can start to measure what goes in and what doesn't, and you can start to save some water or cut down on CO2, and you can have that verified, you can put that on your product. That makes it more valuable. So understanding your impact helps make your business more resilient and sustainable, and that should improve valuation. So this onboarding platform does two things. It onboards according to a set of financial criteria, and it also onboards according to a set of impact criteria. And the two are married together in the evaluation process.
Do you have any specific themes or sectors that you invest in, or is it really any small business that has that impact and financial capability?
We're sector agnostic.
Yeah.
And we want to be generalist investors across a range of businesses to diversify. There's nothing wrong, like the more typical model, particularly in say VC land, is that you'd be a biotech, or you do SaaS businesses, or you do some really specialist space. We have a broad range of skills. We've got people who've grown up and operated small businesses, as well as financial analysts, marketing specialists, property specialists, technology. We've got our own developers who are building the system. So we've got a broad set of skills, and we can use those to look at different businesses. And then we also use them to lend to the businesses we invest in, so that they can improve, make them stronger in areas where they might be a bit weak. So for us to take that approach, we also have to move away from what I call the high church definition of impact. So there's a very kind of specific category of assets that are classified as impact, and those who kind of work in that space will say that the business or the asset needs to have intentionality. It needed to be set up specifically to create that social impact. Yeah. And it has to have a theory of change. A theory of change broadly means is what that impact's going to do, what's the effect of that impact broadly. And you should only invest in assets that meet those criteria. Mm-hmm. Our approach is to say, look, if we can find assets that meet that criteria, absolutely we'll invest in them. But there's a massive number of businesses out there that are operating, and the owners have every intention of doing good stuff, but they don't know what impact is. They've never measured it. They don't, embrace it as a goal. It's not specific to them. We call them impact naive. And so part of the process for us is that when we engage with a business that looks like that, we say, look, if you want to be involved with us, you have to go from being impact naive to an impact adopter. and we take them on a journey to become an impact asset.
Yeah.
And that means we can be investing across a much broader range of potential opportunities. And we can actually be broadening the understanding of impact because we'll be able to show that by embracing impact you improve profitability. And that means it's something that lots of people start thinking about. So we're evangelists to some extent on that ground. But we think we know that there's a massive demand in the space, and there's all this pent-up innovative potential that's not being expressed. So there's huge productivity uplift available to the economy. And the government's kind of got it because they've established the Australian Business Growth Fund recently, so the banks have all tipped in. Mike Baird, the ex-premier, is now going to be chairman, and they're going to be operating in a similar space. And that's fine because there's plenty of room for everybody.
That's really interesting. It seems like you've found this kind of niche, as you say, this impact 3.0 space that no one else is playing in, which I think will be really interesting to see how it develops over the next few years.
Yeah. And it's not, it's not exclusively for small and medium businesses. We also have a group of people here, Linda and Martin, who work on built environment assets. So if you think about impact as having a positive contribution to our, particularly for small and medium businesses, their own communities. The other most important thing in our communities is where we work and play and live and all those kind of things. So the built environment's absolutely core to the idea of impact as well. And so we're also doing some building projects using the same kind of mission, theme and platform to deliver assets that way.
I've got a question that may be a bit left of field, but how do you manage like conviction in this vision for Beckon or anything else you do in your life whilst also being really open to being challenged and learning and expanding the vision of it?
Well, I think you've got to be prepared to recognise that you're wrong, or you need to adapt, or you certainly need to use the word everybody hates, pivot. But in my mind, pivoting isn't like turning 180 degrees. It's like, here's my course, and maybe I get tipped a bit this way, and actually that looks like a better course. So I think being really conscious of not becoming defensive. Because as soon as you become defensive around your ideas or your views, and you start spending a lot of energy defending them from others, you kind of lose the capacity to see that maybe they're not perfect and they could be adapted. So I always start a conversation with people around, what do you think we could do better? What are we missing? What are other people doing that's kind of cool and we're not seeing? And that doesn't just go for Beckon. I try and use that with everything I do. That it's interesting. I think my experience was with my peers and my parents' generation is that as people got older, they become more and more set in their ways and more conservative. And I was really conscious of that. I never wanted to be that person. And what I think has happened for me is I've actually gone the other way. So as I've got older, I've realised I really don't know, not everything, I don't know anything, and I'm interested in lots of stuff. So being really open and willing to say I got it wrong without that hurting you is I think the driver.
That's fascinating.
Really important for all types of investing as well.
Oh, for everything.
Yeah. And I'd like to touch on, so you mentioned the skill set a little bit about investing. For Beckon Capital, you've got this sort of thesis, you've got a process, you've got this tech platform. Apart from all that, what are the really important skill sets that you need to be able to identify and work with companies to build them up?
Yeah, so a really strong understanding of the competitive landscape the enterprise lives in, so the industry or the locality or whatever that might be. Chris and David, so the other two founders, were both equity analysts, trained as equity analysts. I've trained by a guy called Keir Nielsen, who now runs Platinum. So he's deep value analysis. So they both spent their careers basically deconstructing businesses and modelling them to understand all the moving parts, all the cash flows, and then trying to calculate the value of those assets based on the cost of capital to each of those cash flow requirements. So it's quite a mechanical, there's a mechanical basis to it. It involves a lot of judgment, but there's a hard core of proper balance sheet deconstruction and cash flow analysis. And that leads to the ability to model businesses.
Yeah.
And then modeling businesses helps you kind of understand the moving parts. Then you need to overlay a level of common sense and understanding to try and evaluate the potential success of that.
Yeah.
And then put a price on it. So everything's about cost of capital.
Yeah.
Basically. So if you've done finance or economics or whatever, there's a cost. There's always a cost of capital. There's a cost of equity capital. There's a cost of debt capital. The cost varies by enterprise, by term, and it's estimating that risk premium, the magical risk premium. Coming up with an estimate for that. That's the key to trying to figure out whether something looks attractive or unattractive.
Yeah.
That's really fascinating. So Phill, it seems like you're a very reflective person, and I was just wondering if there's anything across your 56 years on Earth that you think the youth or the next generation could benefit from. It could even be related to personal learnings through psychology or anything throughout your career.
Don't let yourself get fat along the way, because that really creeps up on you, and it's really hard to overcome. And I don't just mean physically fat. I think emotionally and mentally fat, and complacent, and it's going to be okay, and I'll do it tomorrow, and that I think slipping down that slope is just really easy to do. And you need to be your own best disciplinary, because you can't really rely on others to do it. You might find somebody around you might be really lucky, like I was. Been married for 30 odd years. My wife will tell me, but a lot of people don't have those relationships. I think also I wish I had done, which I didn't. I said in the beginning I was pretty driven. It meant that there were some things I didn't do when I was young, which I wish I had, because those skills I would be able to refresh and utilise. So I'm thinking about something as simple as surfing. So I'm a surfer, but I'm the world's worst surfer. I've been taken up into my 40s. If I'd spent a couple of summers in my 20s and got the basic skills, it's like somebody at 50 who can't ride a bike, it's going to be really hard to learn the longer you're young. So just think about some of those things when you're younger that you get joy out of. It doesn't necessarily have to be a sport. It could be reading, or it could be acting or singing or whatever. Don't let those skills evaporate and wane, or don't develop them, because what I've found is that as demands of you get greater as you get older, and you get narrower and narrower, if you don't have those other outlets and you've not developed them, and you can't express them with joy, it's hard work to do, then it becomes, it can be a bit miserable.
Yeah, which is interesting, because the hours that like let's say you're starting at Goldman Sachs now in 2021, with the hours you're working, it's very hard to even have any hobbies at all, it's almost paradoxical in a way.
Yeah. Well, as we get to the end of this, we do a quick fire round. Okay. Questions. We're going to give you 30 seconds to answer each one.
Okay.
Number one, what's one of your favourite books and why?
Hitchhiker's Guide to the Galaxy, because I first heard it as the BBC radio show, which was done, like old style in the studio, and I used to listen to it as I was going to sleep, and it just took me to this kind of wacky place with great characters and great dialogue, and I still kind of love it to today.
Yeah, I was actually listening to a video of Elon Musk, and he mentioned the same book.
Oh, did he?
Yeah.
Yeah.
So
that's such a classic thing. Oscar and Lucinda is probably my favourite book. Or The Tax Inspector, maybe. Peter Carey's Tax Inspector. But Hitchhiker's.
Favourite podcast and why?
Jolly Swagman. If you guys haven't listened to Jolly Swagman, he's based in Sydney. He's a guy based in Sydney. He's not much older than you guys, called Joe Walker. And he is an astonishing young bloke. And he does long interviews with really interesting people. And the courage of youth, he calls up really famous people and he says, will you come on my podcast? And they say yes.
Yeah.
So he interviews these people. It's unbelievable that he's got access to them.
We might have to get him on our podcast.
Yeah, he's very cool.
Who's a figure that you find really inspirational and why? Someone you haven't met?
There's lots of them. Pocock.
Pocock? Yeah. Person on our last podcast, Harry Guinness, he actually said Pocock as well.
Yeah.
Because there's this depth of moral. He's had difficult experiences,
Yes.
and troubles. He's morally strong and tough as.
Yeah. Tough bloke, but very socially conscious as well.
Yeah.
And what's one of your favourite hobbies and why? And we've already heard surfing, so you're
So,
another one.
well, I sail a bit and I like skiing, but actually I'm a member of the surf club, and it's not the surfing part of the surf club. It's the side by side play with other people, doing things but being in community.
Do you find that like surfers have this kind of almost this zest for life that you don't see in other communities as much?
Oh, I can't say. I've not sampled the other communities enough, but there is something about the harmony of the sea and the rhythm of the sea. And then what I really like is that my local surf club, all the members basically live in a pretty small, so it's real community.
Yeah.
It's really the community. And the kids come and parents come and you help each other out. And it's just old school kind of expression of the value of community.
Yeah.
And I love it.
Yeah. Cool. And you've already mentioned don't get fat, but for the,
I did.
for the 18 to 25-year-olds that are just kind of thinking about starting their careers and want to have an impact on the world, do you have any kind of bit of advice that you would leave them with?
Yeah, it's cliche, but do something you like, preferably love, but you like, rather than something you think you should. And if you discover that you don't like it anymore, change.
Awesome. Good piece of advice to end up on.
Maybe.
Cool. Well,
Yeah.